Hello everyone. This video is going to cover the inventory purchases budget, a schedule of cash payments for inventory, and then the pro forma data you can get from your inventory budget for demonstration problem 14.1. So we're going to start with part D, and it's looking at the cost of goods sold. It's going to be 60% of your sales. So that's the first thing we're going to fill out in this inventory purchase budget. We know our cost of goods sold percentage is 60%. So what we do is we need to come back up here and find our total sales for the month of January. And from before, we had $400 or 400,000. So this is the row that we need to fill out this first part down here. So when we look at that 240, we're actually taking that 400,000 times 0.6. That's how they get the 240. So now we need to do that same concept for February and for March. So looking at your sales, we got 440 in February. So 440,000 times 0.6. And when we do that, we should find that that would be $264,000. And for March, we get 484,000. So that's how we would find our March budget times our percent of sales. And when we do that, we should get 290,400. So those are what our costs of goods sold are going to be when we actually sell this inventory. So then we have to look at the company policy is to budget an ending inventory balance equal to 25% of the next month's projected cost of goods sold. So what we're saying is that we want to make sure we have enough to cover the first part of the next month before we've actually made anything or purchased any inventory. So to get this 66, we have to take our projected cost of goods sold and then take it times 25%. So to get this 66, we're actually taking February's 264,000 times 0.25. So to get February's, we take 0.25 times that 290,400. So 290,400 times 0.25. And we find that that would be 72,600. Oops, actually, I'm going to. The blue is because that's where we get it from, but this is still your February ending inventory. Oops, sorry, 72, not 76. Now, for March's, we need April's, but in this inventory purchases budget, we only have January, February, and March. So if you go back up into the problem, they say to assume that April's cost of goods sold will be 314,000. So that means we need to take that 314 times 0.25. Which will give us 78,500 for our desired ending inventory. So now that tells us, all right, we need to figure out our total inventory needed. So for January, we had our budgeted cost of goods sold at 240,000. We want a desired ending inventory of 66. So our total inventory is just adding those two up. So then for February, we do the same process. Take that 264,000, add in the 72,600, and what you should end up with is 336,600. Do the same thing for March. Take the 290,400, add the 78,500, and you get a total of 368,900. So that's the total inventory we need. So now to figure out how much we have to actually buy that month, we look and we take out the beginning inventory for the month. Well, in January, we didn't have anything because we started in January. So that gave us total purchases of 306,000. Now, in February, we want to have that 66,000 ending inventory. So that's what we are going to put here, is that 66,000. We need 336,600. We started with 66,000 from January. So that means that at the end of the month, our inventory purchases have to be, when we subtract those, 270,600. Same thing for the month of March. We want to have a desired ending February inventory of 72,600. It's right here. So that's what our beginning inventory for March will be. If that's what we end February on, that's what we begin March with. So 72,600, we subtract that, and we find that our total required inventory purchases that month are going to be 296,300. So that's how we figure out our inventory purchases budget. So next, all the inventory purchases are on an account, we're saying. And so when are we going to pay off these required purchases? So they tell us in Part E that the company pays 70% of the accounts payable in the month that they purchase it. So we're going to start in January by showing that if we need $306,000 worth of purchases, we're going to pay off $214,000. And we get that by taking that 306,000 times 0.70. So then to figure out your current payments for February, we take that 270,600 times 0.7. And then take the 296,300 times 0.7 to get your amount that you pay off in the months of February and March. So when we do that, we're going to end up with in February, 189,000. That's a 9. $420. And then for the month of March, when we take that 296,300 times 0.7, we get 207,410. So now we've got to figure out, okay, that's what we're paying off from this month. But we didn't pay off all of last month's. So if we look at January, we're just going to do that down here. In January, we made $306,000 worth of purchases. We only paid off $214,200. That means we're paying off the rest of it in February, because they tell us it pays the remaining 30% in the following month. All right, so that means you can do this one of two ways. You can take your 306 and just subtract the original 70% that we found, or you could take 306 times 0.3, so times that 30%. Either way, you're going to get the same amount. And when you do both of those, you should come up with $91,800. So we have $91,800 left to pay off of our purchases in January, and we are going to pay that off in the month of February. Thus, we have a total payment for the month of February, when we add those together, of $281,220. Okay. And then we repeat this same process for the month of March. So in March, we are looking at paying off February. So in February, we had 270,600. We paid off 189,420. So what's left? Or again, remember, you could take the 270,600 times 0.3 for 30% just to make sure. And you should find that what's left is $81,180. That's a 1. So we put that 81,180 in there for total in the month of March of $288,590. So that's how much cash we actually pay for our inventory in those months. So now looking at part F, it says use the information developed in D&E to determine the cost of goods sold on the first quarter pro forma income statement and the amounts of ending inventory and accounts payable on March 31st, pro forma balance sheet. All right. Okay, so we first need to look at our cost of goods sold. Well, what are we having budgeted for our cost of goods sold? We've got 240,000, 264,000, 290,400. Add those all up and you get your total cost of goods sold. So it's simply put down here the sum of the monthly amounts for your cost of goods sold. And we should end up with $794,400. So that's our total cost of goods sold. Part B, we need to find our inventory balance on March 31st, or on the March 31st pro forma balance sheet. So what do we have in inventory at the end of March? Well, what is my desired ending inventory at the end of March? It's $78,500. So that's all it is. We would put $78,500 on that balance sheet for our ending inventory. And then finally, we want our accounts payable balance on March 31st. So that March 31st accounts payable, remember, we're paying off 70% in the month of the purchase, and then we pay off the rest in the following month. So if we look at January, we paid off 70% of January in January, and then we paid off the rest of it in March. So that amount of accounts received or accounts payable is gone. This 270, we paid off 70% of it in February. We paid off the other 30% in March. So at the end of March, this 270 is gone. So now we look at the 296,300. We paid off 70% of that in February or in March, which means that at the end of March, we still have 30% of that left. So 296,300. And again, you can do this one of two ways. You can either subtract the 207,400 that we paid off, or take it times, or take it times 0.3. When you do that, you should find that we have $88,890 left in our accounts payable that we will need to pay off in the month of April. And that is your inventory purchases budget, the schedule of cash payments for inventory purchases. So what we just did was we came up here and we figured out this inventory purchases budget and our cash payments for inventory, and then figured out which pieces of those go on those pro forma statements.